And on the investor side, you get to say that you invest, you're part owner of a $20 million asset as well.
Exactly,
So,
exactly.
Which always feels good, right?
yeah, absolutely. So Anthony, maybe you can kind of touch base on what your business model is like. Are you focused on value add, cash flow, or deep value add where the asset is unstable?
And
Yeah,
also, maybe you can say which one of what each one of those processes are.
Yeah.
So the value add process, the just cash flow, where is an A-class asset, for example, or the deep value add, where the asset might not be stable from day one, where it might not be cash flowing. So there's significant work that needs to be done.
Yeah. So let's start then with the stable asset, because let's think of this like kind of like a hierarchy or a triangle, a pyramid of sorts. At the very top, we have our Class A assets. Those are going to be our brand new builds. When you drive around the downtown area and you see all the sky cranes going up, like they're typically building Class A buildings. And these are going to demand a high rent premium. They are at the top of the market. And so they resemble this very safe, secure asset. And it attracts a type of institutional or risk-averse investor who just wants to park their money in an inflationary hedge that's generating some kind of consistent cash flow. Now, it's not going to be crazy cash flow, but it's going to be maybe 5 or 6% cash on cash, which isn't terrible, all things considered. The problem with the Class A buildings is that they're brand new. They're not going to appreciate very much. So if you go and sell them in 5 years, they're not going to be worth terribly much more than what they were worth when you built them. So there's not going to be this big appreciation pop at the end for investors. So that's your Class A. That's more of a cash flow yield play where you just want to park your money. And this is great for risk averse investors or people that are just looking for capital preservation. They already have a ton of money. They just want to park it somewhere nice and safe. A step down from that is what we do is the value add model. And we really like the value add model because it allows us to both benefit from the cash flow, but then also from the big appreciation pop. And the way this works is we go into Class C and Class B assets, and we find an asset where there's a delta between in-place rents and market rents. There's some kind of delta where we say, okay, we can go and increase the revenue that this asset's bringing in, or we think that there's some way that we can bring operational efficiencies to the table to decrease expenses, because those are the two big levers that dictate a building's value. It's all based off of NOI divided by cap rate. So the NOI, which is our net operating income, that's our revenue minus our expenses. So if we can boost our revenue and decrease our expenses, we've increased our NOI, we've increased the value of our building. And that's what we like to do because it puts a lot of control into our hands. So one step down from that then is more of a distressed deal. And this is a deal where there's a lot of value to be added, but it's not stable from day one. So the assets that we go and we purchase, they're cash flowing from day one, even as we go and do the value add, as we're doing improvements on units and on common areas, and we're improving the operations, they still are almost fully tenanted. So they're still generating cash flow while we're doing this transition. A distressed deal might not be cash flowing. It might be a number of years before it cash flows, in fact. And you got to go in there and you got to do a lot of heavy lifting, putting in, a new roof or boilers or plumbing, things that are pretty hard and pretty expensive to do. But the idea is that once you've done all that, there's theoretically a ton of value that's been added. And so at the end, you're going to see really big returns. So it's high risk, high reward. And so it just depends what's the right model for you. It's all based off of your individual investor profile, like how risk averse you are, how quickly you're looking to grow your capital. But for us, it is always coming back to that value add model, because that's where we find that Goldilocks zone of we get good cash flow between 8 to 10% year on year. And then our IRR is typically around 20%. And so really solid returns in an environment where there's pretty mitigated downside. And so that's what we look for personally. Now, before COVID, we were looking at deals that were, I would say, heavier value adds, where there was more work to be done. There was more work on meat on the bone. But COVID kind of scared us a little bit because we didn't know what was going to happen in terms of eviction moratoriums, in terms of construction costs, like labor and supplies. These things skyrocketed through the roof during COVID. So we made a conscious decision to back away from the heavier value adds and make a move towards more stabilized light value adds, where there was still meat on the bone, and we could add value, but that it wasn't predicated on us going in from day one and throwing tons of money at the property to fix it up and make it pretty. And so that's kind of the pyramid, and how you can kind of think of like class A, class B, class C, and the different ways that you might fit in as an investor.